In an investment landscape where everything is starting to look a little expensive, you can still find good opportunities. I'm Jack Otter, editor of Barron's.com. I'm here with Steve Hefter, a private wealth manager at Wells Fargo and a top Barron's advisor. So Steve, let's get straight to the meat. You've got three areas that you're finding interesting right now. Let's start with maybe the most exotic, which is preferred stocks.
Yeah, I wouldn't call it exotic. I would call it a hybrid between stocks and bonds. It doesn't move to the degree that stocks move. It's much less volatile. It pays a dividend instead of interest, but the dividend it's paying is much higher than a comparable bond from the same institution, and 70% of the dividends are tax qualified, so you pay a lower tax than you would on the interest that a bond would pay. So you're getting a higher yield and you're not paying as much in taxes.
Now, with anything, there are some complications. In the case of preferreds, some of them are selling at above par, so you're paying more than you'll get back there. Others are paying lower par, and then you got a higher yield. How do you navigate that?
So if it's pricing above par, that means the dividend it's paying out is above the current dividend. So if the current dividend is 6%, something's trading at 26, it probably has a 7% dividend. So the yield is calculated based on getting 7%, but getting only 25 back. Whereas if you get 6% and getting 25 back, you're not losing, but it's basically the same net yield over time. So we try to buy both preferreds that are trading at the 25 level and premiums, and then also there are discounts, so there are preferreds that trade below. It's really idiosyncrasies within those that make the most difference, not necessarily just a premium or a discount.
And we should say, explain that 25 is because a lot of these stocks are issued at $25.
Correct, that's the par.
They're often issued by financial institutions, banks is
Yes.
popular. But all that said, you get your clients' exposure mostly not by buying the individual issues, but working with a manager, is that right? And so an individual investor can get access through a Nuveen fund or a Cohen & Steers fund.
Correct. I mean, we don't pretend to be able to judge the credits on all these financial institutions and other issuers of preferreds. We want to go with people that do nothing but that. We do a lot of different things. So there are three right now main managers of preferreds who excel in it, who've demonstrated the ability year in and year out to get those kinds of preferreds with relatively low kind of returns with relatively low volatility. So we would rather employ them and have them know the intricacies rather than us have to specialize.
Another place where you're finding some opportunities are in European stocks. They haven't accelerated in this bull market that we've seen in the U.S. nearly to that degree. Valuations are a little lower, dividends a little higher.
Yeah, in fact, in 2012, when we were about to go over the fiscal cliff or not, after we did not go over, we wrote a piece saying we think equities in the U.S. are inexpensive. They're trading at a 13 multiple. We think they could go to a 16 multiple based on where interest rates were.
And they did.
And they went to an 18.5 multiple. Europe is currently at a 13 multiple. And they're doing the same things today that we did back in 2013. So they're keeping interest rates low. They're doing quantitative easing. And we, in the United States, are on the verge of raising rates again. So on a relative value basis, we think Europe is cheap. You don't hear people talking about buying Europe. It scares a lot of people, and that's usually the best time to buy something.
One more area that you're going into is cyclical stocks. Can you explain the logic behind that?
So up to now this year, the dividend-oriented stocks, the value-oriented stocks have gone up a lot more than technology has gone up. Consumer staples have gone up a lot more than consumer non-durables. And other sectors have gone up a lot more than materials or healthcare. So we're going in the sectors that have lagged because we think part of what's driving this rise in interest rates is an improving economy, not necessarily just in the United States, but we think Europe will improve, the rest of the world will improve, and that in turn will help stocks and companies that are growing and more suspect to the economy.
So the cyclical stocks basically refers to companies that do better when the economy
is doing better,
does better, rather than the defensive issues that tend to do well.
Exactly.
Thanks very much, Steve.
Okay, thank you.